Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the weekend edition of the KE Report, the first weekend show of 2026. I hope you all had a very happy new year. And hey, I think we're all looking forward to 2026 to see what sort of momentum these markets, especially commodities, metals broadly, can carry into and throughout this year, because it was a wild end to the year. We're going to talk about a lot of the metals kicking off this show, and in the back half of the show, going to move more to the energy sector. I am starting this show with Darrell Fletcher. Darrell is a managing director of commodities at Bannockburn Capital Markets. Joins me on a monthly basis to really give us an insight from the commodities trading desk at Bannockburn. Really level-headed approach here, which I think is going to be very interesting to get Darrell's insights on silver. We don't usually talk silver that much because simply a smaller market. We do usually touch on the precious metals, but silver is just that smaller market in general. But boy, oh boy, some of the kind of craziness that was happening at the tail end of the year, and also some of the almost fake news that starts to be propagated by all the analysts out there. Actually, not analysts, but some of the new commentators that come into the space. So a lot for Darrell and I to chat about. But Darrell, let's start off with a quick little 2025 recap. Precious metals, best performing asset class throughout the year by a wide margin. Gold up over 60%. Silver up over 160%. A lot of that came just at the end of the year as well. Base metals did quite well. Copper alone was up about 40%. We also saw a run in some energy metals as well. So really, it just seemed like a whole lot more of the spotlight shining on metals because of the runs that they were having. So Darrell, give us a little recap in terms of December and 2025. What caught your eye, please?
Yeah, thanks, Corey. It's interesting. It's been a fun year for sure. This last month here, beginning of the last few trading days, really reflected what we've seen on the year. It really is another reflection of what we've seen the whole year. I can kind of run through like the big picture, and then I like to look at sectors within those. So the Bloomberg Commodity Index, total return, it's going to be up about 19%. Spot indexes, real broad look, commodity across the board, it's going to be up about 16%. Now, the subsectors, as you alluded to, completely led by the precious metal sector. The precious metal sector between silver and gold, call it up 80%. And then London Metal Exchange Index up about 28%. That was led by copper, but also aluminum and tin had really good years. So strong year across the board in metals, precious, base, even steel, even the steel markets were higher. And then the laggard was energy. So energy's down about 11%, we'll call it. Crude and products. Crude's going to end up on a front month basis down around 19% on the year, which is really what I thought. We would grind lower. Then, on the broader picture, even the agriculture index is down about 5%, but that's nominal. So yeah, metals are really higher, like amazingly higher. We talked about it before the show. For me, I've been trading commodities for 30 years. It's been interesting and kind of nice to see metals take the spotlight this year for sure. Across the board, it's been really interesting. And then I think, I'll do my year review and 26 outlook coming up, and it looks like top spot's going to be for silver. Silver and platinum were coming into this week. I thought we'd have a couple of days of trading here, and it'll be fighting it out for the top spot, but it looks like it's indeed going to be silver will be the leader. But the sector views I had for 25 really did fall in line. I guess I got lucky this year with precious metals being my highest conviction to be higher. Base metals were constructive. The energy sector with crude, grinding lower. It did what we thought it would do, and those fundamentals still aren't very good. I guess you could sum it up. The one thing I didn't see was the outsized moves of directionally, yes, but I didn't think an ounce of silver would end up higher than a barrel of oil by the end of the year. So it's been an interesting year for sure.
Darrell, let's talk about the fundamentals that matter to you, because I feel like everybody ties in different narratives and different so-called fundamentals that are driving these prices. And I think sometimes fundamentals matter in the long run. Sometimes in the short run, it's simply trading momentum, where traders are positioned and where some of the fast money runs to. But right now, some of the main fundamentals that everyone keeps talking about is, quite frankly, a bit of a shift away from the US dollar or the US markets broadly. Even though the US markets were up, they still underperformed almost every other developed market out there. Plus, we also have, look, rate cuts that were slow coming this year, but they did come at the tail end of the year. And we even have some forecasts for more rate cuts next year. All these supply shortages. We keep hearing about how there just aren't enough metals, whether it's base metals, even now tying in silver. We keep hearing there isn't enough silver out there. That seems to be a key for the bulls to latch onto as well. But curious, in terms of the fundamentals that matter to you, what matters?
Yeah, I mean, fundamentals, that's what I follow. I'm not, really following the technical levels as much. Clearly, there's been money chasing and there's been a lot of momentum in these price moves. And silver is always going to move in tandem with gold, but, it's going to have bigger moves, higher and bigger moves lower, just because it's a smaller market. But, you did have the fundamentals you noted are the ones that have been driving this all year long. Heavy debt loads, rotation from government bonds and those types of financial instruments, to some extent over valuation, the equity markets. So you just had more and more of a rollover move into hard assets, and gold's going to lead the way there. And then silver has, a dual capabilities really, because it's also used in electronics, solar panels, things like that. So that's kind of the next step down, and the platinum and palladium also have more industrial use also. So there's a dual use there on both of those. So I think the valuation gap also between gold and silver came into play to some extent this year. We're, in the start of the year. So those ratios have come down. So it's been a pretty, across the board solid move for it. The other bigger picture I'm spending more time looking at is how long have we just been underinvested in whether it's copper, silver, mines in general. That's a long cycle that's starting to turn finally. And I think that kind of is why I'm spending some time looking at, are we on the front end here of a really longer bull cycle in commodities? Because this stuff's needed now.
Now, when you talk valuations, how about the valuations if we compare something like gold to the US equity markets? We all kept hearing about how much paper assets were dominating inflows, and quite frankly, hard assets just weren't garnering much, that they were being ignored. But just the run we saw this year in terms of gold outperforming the markets, we are now at levels that, quite frankly, gold valuation we haven't seen since 2020, the spike there, but we would go the whole way back to 2013 to see this sort of, I guess, ratio of gold to the S&P. Is that a key contributor here, almost in maybe a longer term sense, as you alluded to a couple of times, of a shifting market more moving to hard assets?
Yes, and I think that's the question is what's the level that, everyone, it's different for everyone, obviously, from an investor's perspective, but what is the right level? But it just has been ignored for so long. And I just think, on a percentage basis, there could be, continued long move into hard assets. It's, just basically the next alternative to move into to round things out in terms of diversification.
So curious how you view what countries are leading this, I guess, resurgence in metals, because it seemed like for the last decade plus, we were talking about China and maybe even India, but mostly China, driving a whole lot of the commodities, having a really putting in a floor price for a lot of these commodities. But a lot what I was seeing in terms of ETF inflows this year was the US really picking up the steamer. North America broadly getting more invested in metals, commodities across the board. What were you seeing?
Yeah, the same thing. I mean, it seems like the West is still playing catch up from what's happening in the China, India type markets. It's interesting. It's like things have come into view now on this that have been out of view for a long time. And that's why I really wonder if we're in very early innings, you and I are both big baseball fans, and we are very early innings here on this rotation, and maybe there's not even a pitch clock on right now, so it could be long. I mean, you see the moves, you get sell-offs, they bounce right back. We had a sell-off on Monday, huge move up on Friday. Volumes have been light in the holidays, so you're getting some, really outsized moves probably. But it seems like every time these move higher, they get floored and they just move right back up.
Darrell, what historical reference do we have? You said you've been in this market for over 30 years. I've technically been in it for about 20 years, but much more active in the last 15 years. And look, I've been on record saying this year was really the most important year, the best year that I've seen in about those 15 years. Clearly, we can see by price moves, whether it's equities or the metals prices, and simply the outperformance across any other metric you want to use in markets, that yes, the numbers say that this was the best year in well over a decade, maybe multiple decades. What's your assessment on the historical reference of what 2025 was like and what that could mean for 2026?
Yeah, I mean, there's a record year. I mean, I like to look at inflation adjusted ratios on these, but basically it gets to the point where you're like, okay, another record, whether it's copper, platinum, silver, gold. It is what it is. And I think the big question right now is two, and going forward is, okay, things have changed, clearly. We're going to have new floors here. What's the right valuation? Really hard to tell. Technicals don't come into play now here when you've blown everything out. I think in the it's called 1 year. I think I like to think of bigger, longer cycles in terms of commodities, especially from a fundamental perspective. But for 26, if you're just looking at that, as I start to look into going forward into 26, I think it's going to take some really critical thinking around. All right, fundamentals really haven't changed. There's a big shift going on here. It seems like it's for real, but how much of the gains that maybe would have come in 26 have already been accounted for in 25? These are huge moves. I mean, huge. The copper silver is going to end up 160, 100%, 170% higher. So it could be very interesting in that we don't, things really don't change into 26. And I'm doing some critical analysis now on that, and I don't really see the fundamentals changing much across commodities. But what does that really mean for price action? Given the big move we've had, is going to be very interesting. I don't have an answer.
So, what will give us an answer to this other than really just recapping in a year's time what we saw? Is the start of the year important? Does that not matter as much to you, considering how much some of these metals went up at the end of the year? How, as we progress through next year, are you going to be watching it, and what will give us maybe a little bit of a heads up of how the year's going to progress ahead of us?
Yeah, again, I think the price movements are going to be volatile again. So I think you have to be really level-headed around, are the fundamentals that made these things happen staying in play? I don't see them changing. We're going to have a lower interest rate environment that seems to be pretty well drawn out. Just in how much lower is going to be interesting. Fundamental demands on these things, tracking those, and you're going to have to be steady and have a longer view. The other, then, when it comes to metals, you always have mine output and mine disruptions, which we had plenty of those in 25 also. So how fast are these things coming to market? Is there real investment in terms of getting metals to market? The other things to watch will be global copper, for instance. That global copper inventories may, from a global perspective, may not be changing as much as the price seems to reflect, but a lot of it's moving to the United States and out of the area. So there's huge shifts in these supplies right now going on. And that's, a reflection of some of the geopolitics going on now too. So I don't think these things are going to change next year. I really don't. And speaking of like shorter term commodity as we get into 26, you bring up a good point I wanted to touch on. There is going to be rebalancing going on in some of the major commodity indexes, namely the Bloomberg Commodity Index and SPG CSI, which typically is kind of noise on the roll period in like mid-January is when these start, I think, like that second week. Typically, it's just kind of noise, but because the moves have been so outsized in the precious metal sector, the formulas are a little complex, but the weightings are going to basically produce some selling in silver and in gold open interest to get the weights back in line because they do have caps in terms of both individual commodity cap percentages and also the sectors. that make it up. Like for instance, basically the BCom index, the way it's looked at, there's a couple different versions of it, but energy's 25% roughly, ag's 25, industrial metals 15, precious metals 26. But because of the weighting is a formula of both production and liquidity, to some extent value, there's going to have to be some movement to rebalance those down. I think there's a little bit of energy and ag buying that will happen to rebalance, and then just marginal maybe gains in crude and some base metals, believe it or not. But the biggest move will be in some selling on the precious side. But that should be, I mean, it's going to be higher than normal, but that should be a little bit of noise in like second, third week of January.
Okay. Yeah, I was going to bring that up. So thanks for addressing that. So, hey, that almost just means more volatility, maybe even another buying opportunity for those wanting to get back in or trade those metals, especially the precious metals. Let's move now into individual sectors, individual commodities. I want to start with silver because, boy, oh boy, just this last week, silver came into the week on Monday. The price spiked over $80 an ounce. Then it dropped on Monday down to $70 an ounce and has been rebounding throughout the week as we're recording this right before New Year's. It's back in the high 70s. When we get these price spikes, I find we get a whole lot of misinformation out there. A whole lot of stuff that I was reading is that this is a short squeeze and that JP Morgan and other banks are running scared. I do see the short squeeze angle to it. Also hearing that there's a silver shortage. Governments are front running this shortage because they know it's coming. People looking at the COMEX inventory saying that the registered category is dropped by 60 or 70% just in December. That's showing this shortage happening. Darrell, what's your view on why we're seeing this volatility at the end of the year in what has been a spiking market for the last couple months?
Yeah, I try to stay kind of level-headed on it because the headlines have taken over. This is really in the commodity space what pretty much everyone wants to talk about is silver because it's been a fascinating year. And then we had the huge run up last week. You had margin increases, so it sold back off. A lot of different announcements around the shifts again, like copper. Part of the stocks available in London is it's moving to the United States because I think that the tariffs and tariffs are going to stay on the board in this administration. That's a leveraging tool they have, and they're going to keep using it. So yeah, the headlines kind of rallied this in the end. I think also, as we all know, the end of the year you have lighter trading volume. So like that move on Friday, I think there was really no defense out there to keep it from just moving higher and higher. And then you've had such a big move up, people are jumping on it. See a big momentum trade there. Then sold back off on Monday and back up again today. So it's really hard to tell what the real value is here right now. But I think the fundamentals have been positive. Clearly, the moves in silver are always going to be outstretched versus gold is going to overshoot and undershoot. So you got to stay level headed for sure.
Oh boy. It can be hard, though, especially when you're seeing a market just spike. The chart is just wild to see what's there. Question, though, on that short squeeze narrative, this does seem a bit like a short squeeze, though, doesn't it? Especially at the end of the year with those thinner trading volumes.
Yeah, and I think a lot of that had to do with the cost for leasing in London and some of the movements of the actual physical and the flows into ETFs. So I don't know. I don't know that it's been fleshed out for sure, but the price action there was basically they were running scared here in the past month or two on certain days.
So, Darrell, what about those CME margins being raised? Look, this does happen when you have a spiking market. From my understanding, it's simply because CME, look, when you have lower margin requirements, people can move the market even more with less money. But the one argument being the last time we saw margins raised quickly, and the expectation is these margins will keep getting raised, was back in 2011. And I believe in May, the margins were raised 5 times in 9 days, and that, for the most part, really put a top in the market. What's your take on these margin requirements being raised for silver?
Yeah, that hit. I think that's partial what the sell-off was on Monday with the margin increases. Yeah, I think from a margin perspective, that tends to flesh out some of the momentum, which is kind of the price action we saw. It kind of makes sense. If you have a big increase, it's going to flesh out kind of the marginal. type investor or the marginal positioning. So it's honestly, it's probably pretty healthy. So I think it's probably a good move, and then we just kind of move on from here and try to stick back to the fundamentals.
Yeah, what these fundamentals are. Again, when you see a market move that much, I'm sure we do need more silver being mined because it's being used. But again, this sort of a move kind of goes outsized of any sort of longer term shortage that we need. Let's talk gold then, because the whole narrative for gold heading into this year was central bank buying. And it doesn't really seem like central bank buying has slowed down. Central banks have been buying gold for quite a few years now. I believe it's in between 5 to 10 years of pretty steady purchases, plus the whole rate cut narrative that even though everyone expected more rate cuts, we still got a couple at the end of the year, and now people are expecting even more next year when Trump gets his person leading the Fed. But we're also hearing about this new BRICS currency called the unit. 40% backed by physical gold, 60% backed by the BRICS nations' currencies. What matters for gold here? What are you paying attention to?
That's interesting. Yeah, we talked about that prior to the show. That's an interesting concept. It would not be out of line with the general thoughts right now of what we talked about, basically general moving to hard assets and different ways to do that as a financial instrument. So that's interesting. I don't know. Gold, I mean, again, gold's the pure play for this move, and it's a stronger, wider, thicker market for sure. I don't really see things changing that much in the gold market in terms of fundamentals and central bank buying, interest rates moving lower, basically retreating from government bonds and the fundamentals that have driven it all year. So, silver's kind of doing its thing. It's, moving with it, but it overshoots, undershoots, and gold seems to be, relatively speaking, gold's been trudging along, which is hard to believe.
So, I guess the positive outlook for 2026, but again, that whole question of how much of those gains been pushed forward into 2025, I think that question more so for silver because of the spike at the end of the year. What about copper though? Copper, even it's done really well this year, closing the year really at all-time highs. It had that one spike on the tariff news earlier in the year, and after that sell-off, once that clarification was issued by the White House, I guess, then the copper dropped, but then just kept grinding higher. It's a strong copper market, which also is somewhat confusing to me because copper and crude are supposed to be more looking ahead to overall economic indicators, but they're going in completely different directions. So, just in terms of copper, what's it telling you? Is the economy strong or is this a shortage narrative?
Well, I think it's a shortage narrative to some extent, but it's also the way that the world is moving and the need for metals as we decarbonize and reindustrialize the infrastructure. It's much more a reflection of that. And you're right, both CME, COMEX type copper is up about 43% as we speak on the year, and LME same. You're right, we had that big flush out in the differential in July, although COMEX copper is still maintaining a premium. And then it's just kind of gotten right back in line and moved up. It's been more in sync with gold in terms of its movement. And meanwhile, crude's been moving down, but I think that's more of a reflection of the changes in the energy space and basically just rollover of the types of commodities are going to be being used and being needed going forward. It's very interesting. COMEX forward curve, okay, let's call it we're in the 575 range here this week, but the forward curve is in contango. You go out in the late 20, let's call it late 29, 28, 29, you're at 650. So that's a pretty strong outlook for copper. Then, the amount of copper that's going to be needed and the amount of copper that's going to be produced as we get into 2030, there's a big gap there, really big gap. A lot of it's just a combination of things, but it is basically some reindustrialization of the country infrastructure that's needed, whether it's AI or not, EV, just going to be a much bigger component use of copper. And you've seen that to some extent in some of these other metals, whether it's been tin is up 44% this year, the same. Those are the two leaders on the LME for the year. Tin, kind of like silver, is a really good conductivity for electronics uses. So, yeah, that's where I think it's going to be really interesting. You brought this up, this copper, called copper and oil. They're not correlating, and I don't see that changing either. I don't see like that general tie together anymore, just because of the way things have changed going forward.
The one big argument I get too is that bringing copper supply online is vastly harder than bringing crude supply online. When price goes up, we do see more crude, more production. Quite simply, copper, it takes years, sometimes decades to get a mine up and running. And quite frankly, we've been seeing more or less these long life mines start to produce less and less. So that's the argument that I get in terms of why crude and copper could be also going in very different directions. Let's talk crude, though. We won't spend too much time on this because the back half of the show, we are bringing on Josef Schachter, who really is focused on oil and natural gas. And I know that he has a much more positive look for 2026. But look, crude, the price has really been cut in half since the highs in 2022. It's been a persistent, grinding downtrend. And crude, quite frankly, is ending the year really at lows for the last few years. Any change that you're seeing in the crude outlook?
Yeah, I do follow crude. I mean, it's going to end up around down about 18% on a front month basis. It kind of did what I thought it would do. It ground low. It kind of kept grinding lower throughout the year. Although one thing that's caught my eye in the past couple of weeks is this 55 to 57, we call it $55 level on WTI has held. So I'm just watching this because 55 to 57 has held multiple times, doesn't want to go below that. The forward curve is really relatively flat through 27, call it 58, like really flat. And then you start to take up in 28 up to the 59 level. So yeah, fundamentals don't look good. The surplus of 4 million barrels per day is, I think, what some of the agencies are looking at. But the thing that's held it up here in the past few weeks specifically are the geopolitics, and those aren't going away either. Now, Venezuela's not a big producer, like what 1%, but it's getting a lot of headline. But Russia, Ukraine, that has not come to where they wanted it to be. So fundamentally, it still looks bearish. But one thing I'll say is I've traded crude for a long time. The longer it kind of holds these bottom ranges, the more it can kind of build from here. So I don't know. I'm kind of neutral. The forward curve is showing the same thing right now. OPEC Plus meets this week. They don't expect any changes of that halt in production increases. Those will be the things to watch, I think, going into 26 on the crude side. But it did pretty much what I thought it would do this year.
Now, quick question on nat gas. Winter time, we usually do see the nat gas price move higher, but the one thing that I want to get your insights on are LNG exports. I feel like we've been talking about these LNG terminals coming online for the last few years, 3 years maybe, and they are finally starting to come online. The big question being, how much is that going to impact price, and does it quite simply set a higher floor price for nat gas because of these LNG terminals and the export abilities now? What's your outlook for nat gas and how important and where do we even stand with these LNG exports?
Yeah, the LNG numbers have been impressive. We've been running 18 to 20 BCF a day here in December in terms of exports, which is hitting record levels. I think if you look back at some of the forecasts, we're kind of running ahead of what was expected. And there's probably, depending on how you look at the projects, whether it's just US or Canada, but you're looking at getting into 35 to 40 BCF here by the end of the decade. So that's sizable. Now, production has been strong. Seasonally, we're still in that 110 BCF range, which is really strong for this time of year. We haven't had, you have to really look at it, production's running high, but nothing's really gone wrong. We haven't had freeze offs really per se, like we can get. We didn't have a hurricane season. So production's been running really well. I would say most of these companies are still being very disciplined too. So I was constructive on natural gas this year. It did run the 25. I look at front month average. It's going to be around 360 range, and 24 was 240. So yeah, it was higher this year for sure. 26, 27, the forward curves, you're looking in the high 390-ish, 380, 390 range. So I'm generally constructive again on natural gas going forward, to some extent around LNG, because that is kind of it's a sticky, like once it's turned on, you're not going to really be super motivated to turn it off. So it's a constant pull. Interesting thing on the move we had in the past month with this volatility that run up into north of 5 and then sold back to 380. So it's the fun winter gas trading where you have these huge swings. December got off to a really warm start, and then the second half has been cold. First half of January is looking warm, above normal again. So 5-year average is right in where we are in inventory right now, is right in line with the 5-year average, like dead on. So we're in pretty good shape. I think the natural gas market is well valued. I think the curve looks right. Right now, we're about to call winter gas right now $4. So, but I'm generally constructive going forward on it, because of LNG, because things really haven't gone wrong in terms of production, things that can go wrong. Like, for example, look at mining, you can have production issues. So yeah, I'm generally positive on it going out the next year or two.
Okay, I get that. So essentially a balanced market, but there are these, again, kind of fundamental drivers that we all know are coming, but are going to at least change a bit more of that demand side. So, hey, very interesting. Darrell, thank you so much for taking some time with us and going around the horn and talking all these different commodities. It has been a very different market and a totally different sentiment towards commodities now in 2026. We all know how many momentum chasers there are in the market. And quite frankly, commodities just hadn't given these investors a reason to come into this sector. Now they are definitely waking up and have been benefiting from these moves higher. Man, 2026 is going to be interesting. Again, Darrell Fletcher, Managing Director of Commodities at Bannockburn Capital Markets. Darrell, thank you so much for your time today. And everyone, stick around. I'm going to be right back, switching our focus exclusively to the energy sector.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
Hi, I'm Rory Johnston, host of the Oil Groundup podcast. I'm also the founder of Commodity Context and have been an oil market analyst for more than a decade. What I love about the oil industry is that it is both unquestionably essential to our modern life, and the supply, demand, and pricing of this indispensable product is driven by an ever-changing cornucopia of geological, geopolitical, and technological developments. Listen as I speak with experts across the industry to explore everything you've always wanted to know about what's moving the market for black gold. Find the Oil Groundup podcast on Apple Podcasts, Spotify, and at clearcommodity.net. Brought to you by the Clear Commodity Network, digital news on the physical markets.
Hi, this is Chris Berry, host of the Power Current podcast. Throughout my investing life, I've been obsessed with a single question. What happens when commodities, geopolitics, and technology collide? About 15 years ago, I founded an advisory firm to help answer this question for both companies and investors alike, and the Power Current podcast is an extension of this effort. Each episode, we dive deep into the current state of the most important markets, companies, and technologies that will power the revolution in energy today and into the future. Find the Power Current podcast wherever you get your podcasts.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. And now we're switching our focus to the energy sector, oil and natural gas, as we're chatting with Josef Schachter. Josef is the founder and editor of the Schachter Energy Report, as well as writes the Ion Energy Report, which is now on Substack. The Schachter Energy Report focuses a bit more on the companies, while Ion Energy focuses on more the macro, what's going on in the oil and natural gas space. And Josef, because it's the end of the year as we're recording this before New Year's Day, we are going to recap 2025 and look into 2026. We've been chatting with you off mic, and quite frankly, I was coming into this call thinking that the oil sector has been pretty disappointing. Technically, oil traded at the lowest price level that it has all year in December, bounced a little bit in the later part of December, but oil's been really in a downtrend since the highs in 2022, and prices have been broadly cut in half over that period. Really seems like the oil sector just continues to be under this, in a way, relentless pressure, but the stocks, weirdly enough, are holding up quite well. And as we were talking off mic, a number of winners in the oil sector. So, Joseph, just from the oil price aspect, look, it's been a multi-year downtrend. Is 2026 finally going to turn this downtrend?
Well, let's start, recapping 2025. If you recall, at the beginning of the year, price of oil was $79. And I started seeing that there was an inventory build in the United States. Demand was weakening for gasoline and other products. And we said there's going to be a correction. And then in March, April, the price of oil went down to $56. And we have three items on our checklist for buy and our table pounding buy signals. And one of them is the price of oil going below economics, which if you look at the Federal Reserve of Dallas, they have sheets in their presentations, and it comes in the mid 60s, some as low as, 58, some as, 70 for the different basins, but the average is in the mid 60s for the break even. Well, we got below that. The second one was we were looking for the S&P TSX Energy Index to go below 240, and the index at the time was trading at the high of the year was, at the beginning of the year was 288, and it went down to 214. It spiked down below the 240 target, and we were using that in April to be signaling the buy signal. The third one is the S&P Energy Bullish Percentage Index that we talked about many, many times, and it was trading around 80% in January. And we said that we thought it would go down below 10% for a buy, below 5% for a table pounding buy, and it went down to 0%. The only time in the history of the index that it went down to 0%. It went in 2008 to below 5%, 3.7, and in 2020 it went down to the 4% level. So this was a fabulous buy signal and gave me the confirmation and the confidence to say table pounding buy. We put out a lot of buy recommendations then, and we said buy the sector. And as you said, the price of oil has done poorly, but the stocks were so ridiculously cheap, trading under 2 times cash flow, a third of NAV. I'll give you a few examples. On the natural gas side, things like Birchcliff were trading at $4.70. They're now $7.50. Bonterra, which is a oil and natural gas producer, $2.56 up to $4.58. One of the stars was in play, trading at $6.50, now at $12.25. Hemisphere, a name that you guys know, great dividend, a penny a month, plus 2 3-cent specials during the year. So we're talking 18-cent dividend. The stock was trading at the beginning of the year or at the low of the year at $1.64, and now it's $1.97. So you picked up 30 cents in capital gain, you picked up 18 cents in dividends. That's a home run for yield investors. So another one was a name that we covered, that Strathcona, which had the natural gas assets and sold them to ARC and to Tourmaline, but the stock was trading at $23, and the high for the year was $45, and they just paid a $10 return of capital, just like Paramount did, when they sold assets to Ovintiv. So there's been a lot of home runs in the sector. You just needed to know where they are. The bargains were there. Sure, you can look at some names and say they didn't move at all, but the reality is, if you're a stock picker, which is what we are, and you focus on the names that are cheap, and you watch the companies, and you go see the companies, and there's going to be home runs. And I would think that the names I mentioned, leading by in play, and Strathcona, you got to say those were home runs in a year when everybody said gold and silver were the only places in AI. The reality is the energy wasn't so shabby if you were in the right areas.
Well, just all the more reason for folks listening in to check out the links down below for Josef's different publications, because I do think it was a stock picker's market, and a lot of those stocks we've been talking about with you all year long, and you were highlighting for our listeners why you thought the value proposition was so promising. Let me ask you this, Josef, if you think that we're going to have an inverse year next year, we went from, let's just say, almost $80 a barrel down to below 60. If we flip that script and go from a little under 60 to back near 80 again, what does that mean for the oil stocks in that environment? Have they priced some of that in already, or are there hedges in place that would come off? What would a move from 57 crude to $80 crude do for these oil stocks?
Well, what I'm finding quite amusing is that a lot of the companies, when they're talking about 2026, and most of them probably are going to wait till January, February to put out, once they see the reserve reports, then they'll put out their guidance. But the reality is a lot of them are shoving 55, others $60 in their 2026 forecast. I'm using $70. I think, we're going to see a rising price environment throughout the year. And just to give you an idea of what I'm thinking, I think Q1 we're going to be down. We might see a correction down to 52, so we're 57 or so right now, 57.80 now, with a range of 52 to 66. Q2 I think will go from a range of 62 to 72, so we'll peak over 70 again. In Q3 I think we'll range between $68 and $78 WTI. And then Q4, 74 to 84. So a peak over 80 in Q4. That's not in the market. Nobody believes that. Everybody is using way lower numbers. And even the big boys in the States are using like $60 WTI. And most people talk about a 3-4 million barrel overhang. That's bullshit. And we can go through that later. There is no overhang in the market. And inventories are not, excessive as the bears are running. Like there's three components to it. And one component, yes, is higher than normal, but the other two are not. So if you want to go through that, we can do that. But the bottom line is, I think that people are going to be surprised that OPEC does not have the production capacity to raise volumes very much. I think we're going to see tariff resolution, which means global trade will stabilize and we'll start seeing growth there, which means more demand. And if we really do want to go and have more data centers and increase the electrical grid in the industrialized world, and we're going to need more copper, nickel, aluminum, all these things, rare earths. And that's going to come from the third world, and they're going to want to have a better sustainable quality of life, which means they're going to use more energy. And to build those facilities, you're going to need more energy. And the people working there are going to want to have, running water, electricity in their homes. They're going to want to drive cars instead of bicycles and mopeds. So I think that the whole negative story is going to change. Like, think about the beginning of the year when we're $79. Everybody was saying shortage, and the price of oil is going to go up. And then then they started swinging to this 3-4 million barrel negative scenario. I think they're going to swing back to the fact that OPEC's got no more, inventories are coming down, and the bullish scenario comes back. And people don't realize how quickly things can change. And my comment to them is, just look what happened to gold and silver. Look what happened in 2025. All of a sudden, people realized, number one, it's a shortage. Number two, people don't trust the currencies anymore, especially the U.S. dollar, which was down, on the year. And they went into gold first and silver second, and then silver took off. So I think we're going to see, we've seen natural gas take off. It's $4.60. It had a high of $5.50. Last year was a $2 scenario, and it's taken off. So natural gas is leading the patch right now. And we have more data. We have more LNG plants coming on in the States. We have LNG Canada's over a BCF, heading to 2 in Q2. We got all the arguments in favor of things picking up. And there's data centers being built in Alberta, which means more demand within the province. So I think the story in natural gas is the best of the two, but I think oil is also going to be a star. And remember, companies are trading at 2 and 3 times cash flow on depressed commodity prices. You plug in $70 oil for the year and 80 annualized in Q4, you're talking a massive increase in cash flow. And if that happens, you're going to see multiples expand. So I'm looking for a lot of stocks in 2026 to be up 50 to 100%, and maybe some even better than that if they really have success with their production levels. So I think that people should really take a serious look at the sector. You can go to large cap names. There's the big ones like Tourmaline and ARC. On the oil side, you can look at the Strathconas and Whitecaps of the world. On the drilling side, you can look at Precision Drilling and Ensign and Total Energy. There's lots of places. And then on the international side, you can look at Valeura, Gran Tierra. There's so many different places to go, Alvo Petro. And so we think that there's a massive shopping spree available. Again, people should decide what's appropriate for them based on the liquidity, dividend requirements that they have, market cap that they have. But we cover 31 companies. We're going to add one new one in our January issue because we have 3 takeovers in the last 2 or 3 months. We lost Coetno for a takeover. We lost NuVista on a takeover, and we lost Step Energy on a takeover. So we're looking to add additional names that we see as bargains that can make people a lot of money in 2026 and the years thereafter.
So, Joseph, it sounds like a totally different year next year, and even from the last couple of years in the oil space. And yes, I understand a few stocks have done well over the last few years, but quite frankly, it hasn't been like the gold or silver space where everything has moved up multiples from where it was earlier this year, even a couple of years ago. Look, you shared with us real quickly there some of the stocks that you like, but let's spend a bit more time on different stages, different types of stocks in the sector, because that's what our listeners really like to hear. So, first and foremost, large caps. The balance between US large caps or Canadian large caps. Where do you see the best opportunities in those types of stocks?
Well, the American stocks are cheap, but the Canadians are much, much cheaper. And there's two reasons why we're cheaper. One, the political situation in Canada. People aren't sure if they believe Carney, Prime Minister Carney, and what they're going to do. This whole carbon capture thing, is there going to be a pipeline west? There's still a lot of debate on that. So, we are cheaper for that reason on the political side. And then on the other side of it is we really aren't having the growth right now in the volumes of the sector, while the U.S. numbers in many cases are showing volume growth because of the LNG takeaway in the U.S. South. We really haven't seen that until the LNG Canada. So when we see the Q4 results coming out February, March of 2026, I don't think we're going to see many companies, unless those made acquisitions, are going to show comparisons that are positive versus Q4 of a year ago or Q3 of 2025. So I think that that's going to be a holding pattern for the stocks until they start showing more production growth, cash flow growth, and those that still have debt problems, that they knock the debt down to under 1x debt to cash flow. So there still are a few companies with debt problems, but they're all focused on paying it down. Those that are in very healthy shape are all talking about, NCIBs, normal course issuer bids, buying back their stock. We haven't talked about Trican on the service sector, but they've bought back, since they announced their NCIB, they've bought back more than half their shares. So the remaining shares, there's massive value there. It's trading at $591. The low for the year in 2025 was $369. So it's had a good year, paying you a dividend, and there's less shares outstanding. So as the company does well in the outlying years, that's going to be incremental to less and less number of shares, which is positive. So let's go to the big cap names. And again, any company that I'm talking about big cap is over $2 billion in Canada. The largest is Tourmaline, $24.6 billion. They produce in Q3 635,000 BOEs a day. They have a base dividend of $2.50 a quarter. So we really think that's an attractive name for people to look at. And, we're sitting with Tourmaline, an $80 one-year target and a $150 bull market peak target. Birchcliff on the natural gas side, we're looking at a $2 billion market cap. We're looking at a $9 target. As I mentioned, the stock had a very good run from the year. Its low for the year was 471, 754. We'd like to see that back off, below, 6.25. If I'm right about a market correction, that could happen. And we're sitting with a $9 one-year target and a $25 market peak target. And I think it's going to get taken over. There's, names like Trican that we mentioned, Vermilion Energy, which is more oily, a $2 billion market cap. The stock, is trading. It's had a decent year. The low for Whitecap was 687. It's now 1150, and we have a target on Whitecap of $14 this year, 25 bull market peak. So you can see there's some great names, but the important thing to think about is dividends. We've talked about Freehold before. It's trading, the last count I did for my run, 7.1% dividend yield. You have Whitecap with a 6.3% dividend yield. And then if you go to names like Marin Energy, which is a $1.2 billion market cap, a 10.9% dividend yield, Surge Energy, which you guys know very well, 700 million market cap, 7.3% dividend yield, monthly dividend equal to 52 cents annualized. On the stock on Surge, the low for the year was 437. It's now 691, and the high of the year 785. So another story that, if you want dividend income and market cap and liquidity, you've got that. If you're looking for growth stories, there are names that can fit that bill, which we really think people should look at. And growth is hard to find in the sector, so I think that's something that we're looking at in our names. And then the service sector, because if the industry does well and utilization goes up, day rates go up, both for fracking and drilling units and service rig units, and that's going to be a leverage to make those stocks do well. And, as we talked, Precision, Ensign, Total Energy, there's a lot of names there. Total has a dividend, the others do not. A moderate dividend, but still a dividend of 2.6%. So there's lots of things for people to look at. And, on the international side, we like names like Valeura, which is offshore Thailand. We like Alvopetro, which is onshore Brazil and some production in Canada. Gran Tierra, which is Colombia, Ecuador, and Canada. So there's lots of ways for investors to invest in the patch. And, I think that if I'm right about the price of oil getting over 70, I think that's going to be the catalyst for the stocks to react, which is Q2. And then in Q3, as we start seeing 70s on a consistent basis, and then that's going to be when I think multiples start expanding. And really in Q4, when they see an 80 handle, that's when you're going to really see the trajectory of the stocks take up. So you want to buy them in Q1 if we have this correction. My guess is it could be between February, March, April, down below 50s, 54, 52, 54 at the low for oil. I think the S&P TSX Energy Index, which is now at 297, goes below 240. And the S&P Energy Bullish Percentage Index, which has come off 70%, it's 49% now. I think it gets below 10%. And with a little bit of luck, if it gets below 5%, it makes my conviction even higher.
Well, Joseph, you covered a lot of ground there with the big caps, the dividend-paying stocks, some of the service companies, international. When you hit growth, though, you kind of shot through it. So let's focus on the growth names, the ones that have the best growth wedge for 2026.
Well, that's where I have a little bit of a problem, because a lot of them this year, because natural gas prices were very low, you didn't see much growth. But I'll give you a few that do have growth, into the end of this year and then much more in 2026. Paramount Resources, which is, sold assets to Ovintiv, but the remaining assets, they've got a very strong growth profile to them. So we like that name. Whitecap Resources has got growth planned of, 5% in their numbers. Bonterra, we see much more growth in 2026 than in 2025. Obsidian Energy, after their sale to InPlay, they're now from their base after the sale are showing signs of growth. Pinecliff, which didn't do any drilling in 2025, held off because they were waiting for gas prices to recover. They're now starting to drill again, and we'll see the results starting in Q1. Surge Energy, which has had kind of flattish production, they should start showing some growth in 2026. And then you go to some other names. InPlay Oil will probably have flattish production in this year, but 2026, as they get their debt down, they're going to start showing some growth. Petrus is another small cap, 250 million. That's 9,000 BOEs, 9,800 BOEs a day in Q3, could punch through 10,000. Rubellite, which is 12,400 BOEs a day, mostly Clearwater heavy oil. They should start showing some growth. So, and then Yangara Resources, which is Cardium, 9,500 BOEs a day. They should show a little bit of growth. So 2026 is where the growth comes in. For companies that had debt, their focus will be on early part of 26, first half, pay down debt, and then the second half start drilling. And as I mentioned, Pinecliff has already started drilling because we're looking at over $3 AECO right now, which they can make money on. So they're also looking at light oil prospects, that have natural gas as well. So they're looking at dual product performers in their drilling program. And Phil Hodge, I think you guys know, you've interviewed him many times. He was very prudent during the tough years, and now he's pressing on the gas pedal rather than the brakes.
Okay, Joseph, a lot of companies there to consider. How about ones that are more of a blend of oil and natural gas? If natural gas, since that has done well, if that has a positive outlook as well, do you like those stocks that are less pure play, more, I guess, balance between the two?
Well, if you look at Paramount, it's 48% liquids, 52% natural gas. Vermilion is 33, oil 67. Whitecap is 61.39. Bonterra's 51 liquids, 49 natural gas. I'm just going through the mix here, and I'll read off the ones that are potentially mixed. Questair 52% liquids, 48 natural gas. And then you've got Yangara, 42% liquids, 58% natural gas. So a few of those there that have the mix that can do well in 2026 with higher natural gas prices. I'm using, I think this year, the average for natural gas is going to be somewhere in the 240, 250 range. Again, I don't have the Q4 numbers now, but the numbers were in that handle. I'm using 325 in my numbers. We're right now 315 in ACO today, and I think we're going to see better pricing in the second half of 26 because LNG Canada will be running full out. Data centers will be on using more gas. And I think storage will come down sharply. We're seeing, quite a bit of storage down in the States. I pulled out the numbers from EIA today, and we just had another 166 BCF taken out of storage, 3.4 TCF now, and it's 3.6% below a year ago, which was 3.54. The one that I've been waiting for is get below the 5-year average, and this week it happened, down 0.7% to 3.43 TCF. And that, if you remember at the beginning of the year, was 8 or 9% above the 5-year average. We're now, for the first time, below that 5-year average, which sets up natural gas to be a very strong performer, in the U.S. market, NYMEX, in 2026. And if that's the case, they'll be drawing from Canada because they need it, and then Canada will be drawing more to the West Coast because the LNG's there, and then data centers, electricity needs. I think the bad news for natural gas in Canada, stranded gas, is now over. And I think we'll see that being the reason. And that's the reason why some of the names like NuVista got taken over. It was $11 in April when we recommended it, and it got taken out at $18 by Ovintiv. They bought out from Paramount. They bought NuVista out because Ovintiv, the old Encana, wants to be a very big player in the Montney and the Duvernay and wants to be a very big player in the export market to LNG.
Well, Joseph, that brings up an interesting point about capacity and pipelines, and some of the oil service companies, benefit because their pipelines are full, but is there opportunity for growth in pipelines? Could you maybe speak about that aspect of Canada and getting more gas or fluids to different areas with pipelines?
Well, the problem is the costs of them have just gone, stratigraphic. On the oil TMX, how that was like a 3-bagger, 4-bagger, more than the initial estimates. Coastal gas was a massive overrun, and TransCanada had to take a big write-down. Small tweaks, adding compression, you can do that and keep the costs under control, assuming, you can get Caterpillar equipment, which is, an 18-month lag now, given the backlog they have. So I don't really see major pipeline expansions in Canada for a number of reasons. One, the cost overrun. 2, the federal government not so keen on liquids. And number 3, the First Nations have to buy in. And right now, the First Nations have said no dice for an oil line in the northern part of BC. And add one more. The Premier of BC doesn't like the idea either and is crapping on that idea.
Yeah, it's kind of a mess over on the West Coast. And hey, I live in Vancouver. It's always kind of disappointing to read what's going on. But one more, I guess, on the stock front is M&A. You even mentioned you had, 3 recent takeovers just in the stocks that you cover. What's your outlook for M&A into 2026?
Well, as we see the FIDs, final investment decisions, made on LNG Canada 2, which will add another 2 BCF, which could come on before the end of the decade, because the basic facilities are there. Then you've got the issue of, Kissimmee, Cedar, all of these pipelines, get their final decision and start doing construction. Then you're going to have more takeaway capacity, and they're going to want to lock in 20, 25-year contracts for the gas so that they can export and have export contracts to Asia, to South Korea, to Japan, to China, to wherever. And so we're going to see more and more M&A and more consolidation of the plays, going forward. in the next few years. And, both the Montney, the Duvernay, and, all the way from, West 5 in Alberta, all the way into Northeast BC, the whole fairway is there. And there are smaller players that can be consolidated, that potentially Birchcliff, Kelt, there's so many names you could throw out there that Advantage, they all could be taken over if there's a merger mania phase and people need to lock in long-term reserves. That all will help the sector going into the next few years. And I think also if you are in an area, like the Charlie Lake, which is light oil, and people want that play and they want to own light oil because differentials widen between light and heavy, then you're going to see, consolidation of that. And companies that have pieces of the Charlie are going to see themselves and people knocking on the door to say, look, I want to consolidate the land. I want to consolidate the play, lower the operating costs, make more money. And, that's where do you find oil? Wherever there's oil, next to you, instead of going to find a whole new play, is just consolidate the plays around you.
All right, Joseph, we'll wrap it up here. Thank you so much for taking all that time you did with us last year in 2025 and now early on in 2026. Sounds like it could be a very different year for the oil sector. And again, it's just been interesting to see broadly the stocks hold up better as the oil price has been drifting lower and lower year after year. Hey, we're going to keep following up with you throughout this year, and I hope everybody does click that link in the show notes to visit your website, learn more about the Schachter Energy Report and Ion Energy, and sign up with you. So, Joseph, thank you very much for your time on this weekend show. Happy New Year, everyone. Thanks for tuning in to this weekend show. Hope you all had a very happy New Year and are looking forward to 2026.
Happy New Year, everyone.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.